So, revenue, the last part. So we've got two other new accounting standards, which is AASB15, which is called Contracts for Customers. It's a new revenue standard that applies to all organisations, for-profit and not-for-profit. For for-profit organisations, it was applicable from 1 July 2018, but I'm specifically going to focus on the not-for-profits today, where it's applicable from 1 July 2019. The part that I speak about in terms of AASB 15 is equally applicable to your for-profit and your not-for-profit organisations. And then separate to that, you've got AASB1058 income from not-for-profits, which, from the name as you guess, is only applicable for the not-for-profit organisations, and the same start date. So for the not-for-profits, leases, contracts with customers, and income for not-for-profits, they all begin 1 July 2019. So, do the standards apply to you? Same as what I said earlier in relation to leases. Special purpose reporting doesn't mean you can just ignore the accounting standards. You still need to apply them to get true and fair accounts. So let's just look at the application of this. So you've got the two standards that I've mentioned and the dates there. Now there is early application available. So if we were a year back and you wanted to start using this earlier, you're allowed to. And in terms of the initial application, it's the same as the leases standard, where you can either do your full retrospective accounting, go and change last year, or just do an initial application on 1 July 19 with an adjustment into retained earnings at that date. So you've got the options there, pick either one. And again, with this standard, there's a few practical expedients that you can use on the transition to make it a little bit easier, because they are, like leases, quite a significant change in the way things will be accounted for. So, what does the standard actually take us through? I guess the short version is, we've got a new 5-step process for recording revenue. Except everything needs 5 steps, right? So this is specifically in regard to AASB 15. It's replacing the old revenue standard. And in order to be able to apply it, we need to be looking at it and saying, does a contract actually exist? So contract with your customer. Have you got some agreement as to what you're going to provide them? Now, it could be something that a lawyer's drawn up, or if you're selling coffees, it might be as simple as you say to the barista, I want a coffee, they give you a coffee. It's a verbal contract, so it doesn't have to be written. There does need to be something explicit or implied as to what you're actually going to provide, what you're going to deliver. So are you going to give services of looking after people in need or whatever it might be? You need to be able to identify the transaction price, how much is it going to get paid, and through all of that, then at the change of the control of the performance obligations is when the income will come through. So for those of you who had an understanding of the existing standards, there was this idea of when do the risks and rewards pass, and that was the timing when you recognise revenue. So anyone who might have done a business degree 10 or 50 years ago, the whole basis behind revenue recognition is, when did the risks and rewards of ownership pass to the customer? That was the time you recorded revenue. That's when it comes to your profit and loss. That's the old standard. The new standard says, when do you deliver your performance obligation to the customer? When do they have the ability to benefit from it? That's the time that you recognise revenue. Now keep in mind, although I'm talking customers, you might be thinking, we're a not-for-profit, we don't have customers, we just help the community. The standard is still applicable, because whether you call them customers or clients or service recipients or something else, there's someone who's receiving the benefit from what you do. So the standard still applies in all cases. So the 5 steps. I haven't put numbers next to them, but these are the 5 steps in the standard. You have to first identify the contract. Then you have to identify the performance obligations that are in the contract. Then you have to determine what the transaction price in the contract is, allocate the transaction price to the performance obligations, and then you recognise revenue as you deliver on the performance obligations. A lot of new terminology in there, quite a few new concepts, but hopefully I'll make it just a little bit simpler for you so you can go away and think about it, because it is quite a significant change. You also then, as part of that process, will have contract liabilities and contract assets that get recognised through the process as well. So, in terms of not-for-profits, you have revenue that could sit in either standard, could be in AASB15, could be in 1058. For it to be, you start by saying, can it fit in 15? If it doesn't fit in 15, then you go to 1058 to tell you how to record your revenue. In order to sit in 15, you need two elements in the contract. You need there to be enforceable rights and obligations. So there needs to be an ability that the customer can actually say, I've contracted with you to do this, you must do what we've said, or if you don't, give the money back. Or there needs to be some sort of enforceable rights. There also needs to be a sufficiently specific promise of what you're going to do. So if you have a contract that says, here's $600,000, please help the needy people in this community. You can start from this date to this date, and we just want you to do good work. Now, I mean, if only government contracts still were as general as that, it's not really the case as much, but where they are very general, it is not sufficiently specific. In order to be sufficiently specific, you need things like, here's $600,000. You must help at least 100 people move from this place to this place. Or there needs to be numbers, quantities, timings, identifiers that give it that specificity as to what you're actually going to do. It needs to be to the point that you can actually, halfway through the year, say, of what I promised I was going to do, how much have I done? So if you're able to calculate and say, I've done 20% of what I promised to do, you'll be able to record 20% of the income. But if you can't actually calculate and say, I've done 20% of what I promised to do, it's not going to sit in AASB 15 because you need that ability to be able to say quantifiably of what I was going to do, how much percent have I completed so far. So in relation to the grants and service agreements, we're talking about, as we've said, enforceable rights sits in AASB 15. If there's not the enforceable rights, so enforceable rights in a lot of the grant payment type contexts will generally be refund the money if you don't spend. So most grant or service contracts from government will tend to be, here's a chunk of money, go do good work. If you don't do the good work, if you don't meet the outcome, give the money back to the extent that you didn't do the work. That gives you the enforceable rights. The sufficiently specific criteria, we're looking at things like the nature of what you're going to do, the cost of it, quantity, and the time period. But the standard is very clear in saying that a time period alone is not enough. So in the standard, they use the example of a charity that's building wells in Africa. And they say, if the funding body says, here's $1 million, go build some wells. You can start building on the 1st of July and you have to finish by 31 December. Tough luck. It's going to be income when you get the cash because it's not sufficiently specific. But if the contract says, here's $1 million, go build wells in Africa. You can start on 1 July, you must finish by 31 December, and you have to build 100 wells that meet this specific criteria of quality and depth and whatever it is, then you'll be able to say it's sufficiently specific, because the distinction that they're making is saying that the time period by itself is not enough. There needs to be something more in terms of quantity and quality of what you're going to deliver. So I've got two grant contracts just as a quick example, because what you'll be doing is when you go back and looking at the funding you've got, you need to go and look at the contracts you've got to identify. Are they specific? Are they not? What performance deliverables do you have? Like I said with leases, that you need to make a lease schedule with funding. The takeaway is you need to make a schedule of your contracts. Now it might be that, for instance, in a building company, you might have 100 clients with the same contract with all of them, and you'll be able to work this process through, identify the terms in one contract, and then do it on a pooled basis. But in that same instance, you might have one very large customer who gets different terms and conditions and gets a special contract because they're a special person. And you'll have to identify that one separately. So the takeaway you need to take from this is that you need to go and look at all of the contracts you've got, your funding agreements, your contracts with any customers you've got, what are the terms and conditions, maybe you've got them printed on the back of every invoice, and identify that so you can then go and talk with your accountants or advisors and say, these are the contracts I've got, how are we going to implement them? What is the impact that these are going to have? So let's look through these two agreements just to see how that might play out. So we've got the core funding agreement, which it's got a clause in it, clause number 4, that says repayment and retention. If you don't spend the money, you've got to give it back. And then we've got Schedule 1 that says, what are we going to do? So this one's core funding. It says you have to develop some policy positions and advocacy plans, develop support partnerships, assist in improving community attitudes. Would you say that meets the criteria of being sufficiently specific? You'd be correct. It's not sufficiently specific, so it is not going to sit in AASB 15. You're going to then be looking at AASB 1058 to give you the indications of how you would account for this. Yes, it has some guidance on various things you're going to need to do, but there's no quantity or quantifiers in there to enable you to really say, what are you doing? So you look at Schedule 1 in your agreements, no, it's not specific, but yes, there are enforceable rights. It's going to be sitting there in 1058. The alternative, we've got a Career Expo and Symposium grant for someone to put on a Career Expo. Now again, we've got clause 4 in the agreement that says repayment retention. You don't spend the money, give it back. Then we've got the schedule. There's two parts to it. You've got the Career Expo and then the Employment Symposium. The Career Expo says in partnership with the relevant department, you're going to target individuals 60 years and over. You're going to provide participants access to information and advice, increase participants' capacity, and provide some information and resources. But then for the Employment Symposium, which is going to be done in conjunction with the Chamber of Commerce, you're going to host an employment symposium targeting small, medium and large businesses that will focus on particular friendly practices and workplaces and showcase local organisations that are leading the way. Now this one, because of the size of the screen, I've chopped out the bit underneath it that actually says what is particular. But this is an example where you're actually going to end up with two different treatments for the two different aspects of the contract, just to make our lives as accountants fun. You'd end up saying that the Career Expo is not sufficiently specific because it's quite general in what it asks you to do. But then the Employment Symposium, because they actually go on to detail what are these particular friendly practices and give a lot more detail further down, you'd end up saying that the Employment Symposium, you account for under AASB 15, and the Career Expo, you're going to sit under 1058. So just
one grant would have to get reported.
Yes, so you can end up with different accounting treatments for different aspects of the same contract. What else would we do with our time, right? Just to make our lives interesting. So, an example with some numbers just to show you how would this actually play through, what's the impact on your financials going to be, and what sort of things are you going to be looking out for, so that even at the bookkeeper or data entry level of the accounts, you know what you need to be identifying and flagging to the accountants to make the adjustments and journeys towards the end of the year. So I've taken the example where we're going to provide we've got a contract to provide 5,000 service hours to particular clients, and we're going to get paid $300,000 for doing that, $60 an hour. Over the 12-month period, we're going to do 420 hours per month up until the last month where we tail it down a little bit and do 380 hours of service. On top of that, we also have to deliver monthly progress reports, and there's an annual quality report that has to be delivered as well. So there's these three different aspects to the contract that need to be complied with. We've got the actual hours of service delivery, we've got quite an amount of work that goes into monthly reporting, and then a separate activity of annual reporting as well. So working through the steps to say, well, is there a contract? Yes, there's this written contract that details what needs to be done. Are there performance obligations and rights? So yes, that's all there within this particular contract, and in looking through it based on the criteria in this case, you might identify that there are 3 specific performance obligations. You've got delivering the hours, you've got your monthly reporting, and you've got your annual reporting. Now, in each contract, you need to look at it to say, what are the promises or what are the performance deliverables? And when you get to that point, go back to the standard because it gives a criteria of what actually are performance deliverables, and there could be situations where there are things that you promise to do that are not specifically of benefit to the customer or that can't be used individually. So while you're promising to do it, it won't be a performance deliverable for the standard. You can also have things that might be grouped together. So there was a contract we were looking at a couple of days ago where within the contract there was actually a requirement that the supplier had to implement certain IT practices. It was a contract to deliver some IT software and ongoing service, and the contract said you must implement best practice, you must run tests of your IT on this regularity, you must have penetration testing done by an expert on this regularity. So it was something that the supplier had to do. It was written in the contract, but it did not meet the test of a performance obligation per standard because the customer didn't get an individual benefit from that. There was no reporting to the customer. It was just, this needs to be in place. It's integral to the delivery of the product, but it's not a separate item. So it's about looking at the contracts to identify what are the actual performance obligations, what is the customer going to benefit. Once you've done that, you then have to identify, well, what is the price going to be? Now, there's different options that you can use, and in almost all cases, I'm going to expect that it's going to be this estimated cost plus margin where you'll end up being certainly in the not-for-profit sector, because the alternatives is looking at what is a standalone selling price. Now, delivering in the not-for-profit space, there isn't always an active market. You can't go to the not-for-profit down the road and say, well, how much do you charge per hour for this service? How much do you charge? Okay, we know what the market price is. It doesn't work that way. I mean, if you're providing coffees, selling coffees, yes, you can say there's 10 cafes, this is the price they all charge. So if we're selling a coffee and muffin bundle, we can look at the cafes next door to see, well, what is the normal price of a coffee? Not-for-profit space, that's not really going to work. You've got a adjusted market approach and a residual approach. The residual is where you can say we've got this bundle of products, all but one of them we can say what the market price is, so therefore the last one must be what's left over. It's a bit messy. So cost plus margin. Take you through this one and you can see how messy it ends up getting. So looking at the numbers here, we've said that what we're going to deliver is our 5,000 hours, and it's actually going to cost us paying our staff $24 per hour, and we've got some other direct costs that's related to that. We've got 100 hours of accounting work at $60 an hour, and 200 hours to do our annual reporting also at $60 per hour. So all up, it's actually going to cost us $240,000 to deliver this contract. So you know what it costs, you know you're selling it for $300,000, so you've got a bit of a markup in there. So you say, well, we're actually getting that 25% markup, which is what we need in order to cover the corporate overheads to achieve the financial goals, the sustainability of the organisation that we want. Now, the markup in each case will be different, but that's what we've got here. And you can see the cost of 240, we're billing it at 300,000, so that's where we're getting that markup coming through. Because we're using the cost plus markup approach, essentially what we're then doing is we're saying for each of those performance obligations, we're going to identify how much does it cost us to deliver the obligation, and then split the revenue we're going to record across each of them in equal proportions. So we've got 3 things to deliver. We're doing the service, we're doing our monthly reporting and our annual reporting, we're charging the customer $60 per hour for our service, and we're not charging the customer for these 2. But what the standard is trying to say is, well, we need to match our revenue to what we're doing. It doesn't make sense to say that we're charging for one thing and we're doing two things and not getting charged for it. So this is a process that's going to actually, by the new standard, allow revenue to be recorded lined up with each of the things that we're actually delivering to our customer. So we go through and say, well, we know what it costs us to deliver each of the three products. We know that our total revenue is going to be $300,000 and that we're needing a 25% markup on each item. So we can then actually say, on an even basis, rather than putting the whole $300,000 just as service delivery with then nil and nil, we're rather saying, well, $270,000 for the service delivery, $7,000 for the reporting, $15,000 for the annual. So we're actually then splitting out the revenue, linking it to what we're going to deliver to our customer, and we then track the frequency of it hourly, monthly, annually per each event, which then lets us identify a transaction price. So in the sense of the service delivery, we actually are only going to be recording income of $55 per hour, even though we're charging the customer $60, because that $5 per hour is being held back that we will later record as income when we deliver on the monthly reports and the annual reports.
So Alice,
Yeah.
what if, I'm just looking at this, the example is short-term accommodation, where we don't have an agreement in place with people, not a written agreement in place, so it's people staying overnight.
Yeah.
We charge them a particular price,
Yep.
they pay us, that all goes into the bank as commercial revenue. But is that, so if it's, does it fit into,
No.
it
So,
doesn't fit in?
something like the short-term accommodation,
Yeah,
you've got a separate contract with each separate customer,
even though it's only like a verbal.
even though it's verbal. So the contract doesn't have to be written. So like I gave the example of selling coffees, which is even less formal than selling your accommodation space, because even with accommodation, normally there's something they'll sign to say, I'm not going to damage it, and if I do, I'll lose my bond or I'll pay extra for it. So even if I pull it back from selling accommodation back to selling coffees, you've got a verbal contract with the customer to say, I'm going to give you this, you're going to pay me that. You've got the signboard that says this is the price. That's enough to create a contract, but it is a separate contract with each separate customer. So one customer comes in today and says, I want to stay overnight. They stay overnight, they pay the money, that's the end of it. It's revenue on that day. You're not going to need to allocate it out separately. But if you've got one customer that's the same contract over a long period of time, so something like maybe a construction contract where you're building a large building and it might take you 12 or 18 months to complete the construction, and all of that work is for the one customer. Or a contract like the example here where it's service hours, you're delivering for the government and you've got one contract to assist more people, but it's still one contract with the government. It's not multiple individual separate contracts. The result you end up with is you multiply it all through. Looking at the time, I'll just rush through this and you can read the slides afterwards. You end up with contract assets. So the balance of the difference between what you actually are charging and what you're recording as income comes to your balance sheet. You have the ability, if you've spent time working on something that you haven't charged yet, to bring that as an asset to the balance sheet. So a bit like a work in progress type idea. And you can also end up with contract liabilities in reverse. There's a few extra disclosures, and that quickly takes us through 15. 1058 is the income for not-for-profit standard. The items to be aware of in this one is revenue. Where it's not sufficiently specific, it comes into 15. In general, you'll end up with revenue at the time you receive the cash. So anything like the, here's $100,000, do good work. Income when you receive it, because you can't measure otherwise. There's also a volunteer service part of it, which most people won't want to take up, So just make sure that you make an accounting policy choice to say, we're not going to book volunteer services. Peppercorn leasing, which I mentioned before, is temporarily postponed, so until it comes in, don't need to do anything else. Donations, the assumption is that if you're receiving money, it's going to be sitting in AASB15. If you've got instances where you're doing a charity concert, $3,000 a table, but the food's only worth $300, there's the ability to split those out as a donation component and a income component. Volunteer services, if you did it, so something like board members, if you've got voluntary board members, you calculate the value of their time, you could end up with board member expenses and board member donations as an income and an expense. It won't change your profit, but it goes on your P&L. That part of it is optional. Most people are saying we don't want to, it doesn't add any benefit, but in either case the board needs to make an election to say we're going to account or not account for volunteer donated time. Anything that's construction for building an asset, your capital grants, that here's 60,000, go buy a bus, here's 100,000, go build a building. It's income at when you buy the asset or when you build the building. And so, the things I want you to take away from today: leases, make a lease register, identify what leases you've got. Single touch payroll, it's actually not that difficult to do. Just start doing it and then you don't have to worry. And on the revenue standard, you need to identify what contracts you've got and make sure you make an election about your volunteers, because as the auditor coming in, I'm not able to choose for you whether you want to account for volunteers or not. You need to have decided, and then we can check you've done the accounting correctly. So sorry about rushing through the end. And that's it. Thank you for being around. I'm around longer if anyone wants to ask any more questions, and if you need to rush off, thank you for your attendance.
Thank you.